Are you confused over investments? I'm here with a solution of your confusion. Hello friends, I am Arvind Bharadwaj. In this video, I will discuss about investment in mutual fund and ULIP. Difference between both the investment and which is a better investment, mutual fund or ULIP. What is mutual fund? Friends, in simple terminology, a mutual fund is a financial vehicle wherein an asset management company manages the money of several investors. The collected funds are further invested in different securities such as bond, stocks, money market instruments, etc. The performance of your mutual fund scheme is directly proportional to the performance of these underlying assets. Mutual funds are pooled investments that are managed by professionals known as fund managers. Fund managers are mutual funds experts who have in-depth knowledge about the complexities and volatilities of the financial markets and make appropriate asset allocation decisions. Now, what is a unit-linked insurance plan? Friends, unit-linked insurance plan or ULIP is a combination of investment and insurance. ULIP are insurance policies that offer an investor the potential to create wealth while simultaneously providing them with the securities or life cover. Under ULIPs, a part of the premium goes towards providing the investor with a life insurance cover. The rest is pooled and invested in debt or equity instruments or a combination of both to help create wealth in long term. Now, difference between ULIPs and mutual funds are, friends, to gain some perspective on ULIPs and mutual funds, you must first understand the difference between the two investments. Following are some of the significant differences between mutual fund and ULIPs. Number 1, investment objective. Friends, a mutual fund is a pure investment product that offers the sole benefit of creating wealth and has potential to generate reasonable returns in long term. On the other hand, ULIPs are primarily an insurance product with the added advantage of being a market-linked investment. So ULIP is a combination of insurance and a market-linked investment. Number 2, return on investment. The return on ULIPs can be dynamic as they invest in equity, debt or combination of thereof. The returns on mutual funds vary too depending on the type of scheme opted for and can range from slow to high. There is no guarantee of minimum returns in mutual fund or ULIPs. Number 3, lock-in period. As ULIPs are insurance products, insurers define lock-in period of generally 5 years for these investments. Investors cannot redeem their investments in this lock-in period. On the other hand, most mutual funds, especially open-ended mutual funds, do not have a lock-in period except of ELSS funds, which have a lock-in period of 3 years. Now, fourth difference is transparency. As a recent regulatory amendments by the IRDA has made ULIPs quite transparent. They now provide upfront information on funds allocation. In case of mutual fund houses are mandated to provide a detailed information of the mutual fund investment, financial markets. Regulator SEBI has advised fund houses to provide detailed information on asset allocation, portfolio holding, active fund managers, fees charged, etc. Tax on mutual fund. Long-term capital gain tax and short-term capital gain tax of 10% and 15% respectively is levied on equity funds depending on the holding period. For debt mutual funds, long-term capital gain tax is levied at 20% after indexation, while short-term capital gain tax is levied according to the investor's income tax slab. Equity-linked saving schemes (ELSS) qualify for a tax deduction of up to 1.5 lakh under the Section 80C of Income Tax Act 1961. Now, tax on ULIPs. If premium is less than 2.5 lakhs and insurance cover is 10 times of your annualized premium, then returns on such ULIPs are tax free under Section 1010D of the Income Tax Act 1961. Returns on policies with annualized premium of 2.5 lakh or more attracts long-term capital gain tax at 10% flat. Now, sixth difference is expense. Investing in mutual fund incurs professional management fees as well as operational fees, collectively referred to as an expense ratio. Some mutual funds also charge an exit load. It is a charge of leaving the scheme. When it comes to ULIPs, the charge levied includes premium allocation charge, fund management charge, administration charge, mortality charge, etc. Now, risk cover. Under ULIPs, nominee are compensated for the sum assured in case of the policyholder untimely demise. However, in case of mutual funds, the investments are transferred to the nominee. Now, eighth, ideal time to invest. Mutual funds are the ideal investment choice under the following circumstances. If someone wants to invest for a short-term or long-term goal, if someone wants to build your wealth, if someone is looking reasonable returns on investments. Now, ULIP are the ideal investment choice under the following circumstances. If someone is looking for a tax saving investment, if someone is seeking for a life insurance policy, if someone wants to invest for a long-term horizon. Now, most important question, which is better, mutual fund or ULIP? The decision to invest in mutual funds or ULIPs solely lies with the investor. Before investing in any instrument, an investor should analyze their financial needs. The right investment option in one that aligns with the investor's financial goals, risk profile, and investment duration. For instance, if investments need to be liquid, one can consider for investing in mutual funds, as ULIP have a minimum lock-in period of 5 years. Of course, not at all mutual funds are liquid, and tax-saving mutual funds, ELSS funds, have a lock-in period of 3 years. On the other hand, if someone is looking for a insurance as well as wealth creation, one can consider investing in ULIP. In nutshell, the primary aim of ULIP is to ensure the investor's life along with the wealth creation, while the primary goal of mutual fund is wealth creation only. Choose wisely, happy investing. The information given here is neither a complete disclosure of any material fact of Income Tax Act 1961, nor does it constitute tax or legal advice. Investors are requested to review the product information carefully and obtain expert professional advice with regard to specific legal, tax and financial implications of investment in any scheme. I hope you must have liked this video and can be beneficial for new investors. Kindly like my video, subscribe to my channel. Thank you so much, friends.